Hello to everybody. I would like to represent my article in this conference in Zurich, named Digital Economy in Business Taxation. First, I must apologize about my medical state. Because of these medical conditions, I cannot attend this international conference in Zurich. So we have connections through the video articles or video presentation. First, I must represent myself to you. I am a PhD candidate at University of Maribor, Faculty of Law. I am also a manager of Lexiaco firm, and I am also a public procurement assistant at Agency of Infrastructure, Republic of Slovenia. So let me represent my article at this conference. We will talk about digital economy in business taxation. First, we will talk about the digital economy in progress, and then we will mix this digital economy system and rules between all rules in business taxation. Especially, we will be focused on a common consolidated tax-based system. So let me begin this conversation or presentation. Now, first, I will introduce my article about digital economy in business taxation. The digital economy is changing the way in which people communicate, consume, and operate. Digital companies grow much faster than the economy in general, and this trend is expected to continue. Digital technologies bring a lot of benefits for the company, and from a tax perspective, create opportunities for tax administrations and offer solutions for reducing administrative burdens, facilitating cooperations between tax authorities, and addressing tax evasion. However, digitalization also brings pressure on the international tax system to change business models. The common consolidated tax base is a system of common rules for the calculation of the tax base of enterprises that are tax resident in the EU and permanent business units of third country companies in the EU. In applying the current corporate tax rules for the digital economy, there has been a mismatch between the place where the profits are taxed and the place where the value is generated. In particular, the current rules are no longer appropriate in the current situation, where online trading across borders without a physical presence is easier when business really heavily connect on intangible assets that are difficult to evaluate, and when content created by users and data collections become the main activities for creating the value of digital enterprises. So in this slide, you can see EU Internet Day with some specialities of digital presence and digital economy through the internet. So, digitalization of corporate taxation. Current corporate income tax rules are based on the principle that profits should be taxed where the value is generated. However, they were mainly formed at the beginning of the 20th century for traditional private enterprises and determine in what circumstances the country has the right to tax and how much corporate income is allocated to each country, largely with regard to the physical presence in that country and without taking account of the value generated by the participations of users in that jurisdiction. This means that the taxation purpose, not residents, become taxable persons in each country only if they are present at as much as typical for a permanent establishment there. However, such rules do not capture the global reach of digital activities when a physical presence is no longer required for the provisions of digital services. Therefore, new indicators of a significant economic presence are needed in order to determine the taxation rights in relation to new digitalized business model system. What is the basic elements of digital connections? When a business is taxable in a particular country, it is still necessary to determine the profits generated by this business and attributive to this country. However, the current rules developed for traditional business models do not reflect the fact that digital business models have different characteristics than traditional in terms of value creation. The digital economy is heavily dependent on intangible assets such as user data and develops data analytical methods to gain value from these users' data. The objective of the proposal of this new Council directive on the establishment of rules of corporate taxation in relation to an important digital presence is to address issues arising from the digital economy by defining a comprehensive solution within the existing member state corporation taxation system. The proposal lays down the rules for the determination of taxable nexus for the digital enterprises operating on a cross-border basis in the event that they are not physically market-based. The proposal also set out the principles of attributing profits to digital businesses. These principles should better capture the creation of the value of digital business models that relies heavily on intangible assets. Now, what is the field of use? These digital elements. The scope covers corporation taxable persons who are registered or established in the EU and companies that are registered or established in a jurisdiction outside the EU with which no double taxation agreement was concluded with the member states where the tax was paid. We can show the significant digital presence of the taxpayer that has been established. A digital service is a service that is provided through an internet or electronic network and whose characteristics allow it to be largely carried out automated and with minimal human intervention. The provisions of a service with minimal human meditations means that the supplier-side service is provided with minimum human intervention without taking into account the level of human intervention of the user's part. A service provided with minimum human intervention will, as such, be dealt with in circumstances where the supplier first established the system and is regularly maintained or repaired in the events of problems related to its operations. What is an important digital presence? So the notion of an important digital presence should determine the taxable nexus in each jurisdiction. The proposed rules for determining the taxable nexus of a digital company in a member state are based on revenues from the provision of a digital service and the number of users of this digital service and the number of digital service contracts. So in 3 ways. These criteria are approximations to determine the digital footprint of a company in jurisdictions on the basis of certain indicators of economic activity. There is an important digital presence in a member state if one or more of the following criteria is met. First criteria is if the revenue from the provision of the digital service to users in each jurisdictions exceeds 7 million euros during the tax period. The second criteria is if the member states during the tax period have more than 100,000 users of digital services. And the third criteria, if more than 3,000 business contracts for digital service are concluded. So the revenue threshold is set to cover the estimated costs of meeting the obligation to run an additional permanent establishment, even at this low rate. The threshold for the number of users should reflect a similar value in monetary terms on the average revenue per users. The threshold for the number of business contacts should be set to take into account only contracts between companies, since the value of these contracts is likely to be much higher than contracts concluded with individuals. What about gains who are linked to an important digital presence? The proposed rules for the allocation of profits of an important digital presence are based on the current framework used for permanent establishments. They confirm the principle that an important digital presence should be attributed to the profits it would earn through some important economic activities carried out via digital interface. So the first in particular when dealing with other parts of the company, and the second if it were a separate and independent company and would carry out the same or similar activities of the same or similar terms, taking into account the means used, the function performed, and the risk assumed. In the functional analysis of an important digital presence, activities carried out by the company through the digital interface related to data and users should be regarded as economically important functions that are important for attributing economic ownerships of assets and risk to an important digital presence. It follows that the functions related to the development, improvement, maintenance, protection, and exploitation of unique intangible assets would be characterized by an important digital presence. Now we will talk about the harmonization of corporate taxation in the link of this digital presence and digital economy. Member states are becoming increasingly aware of this negative guidance and are therefore striving to take steps toward harmonizing direct taxation of companies in the EU internal market. Member states apply separate accounting rules and determine the profits of each member in the group and the source rule in the case of a profit connection with the member state where the profit is located. Separate accounting takes into account that the market principle of the rule of transfer pricing when determining the value of transaction between member states or members of a group. The European Commission has proposed that member states move from a separate accounting system to a consolidation system or a distribution mechanism for the profits generated by the group of companies in the EU. The proposed system of corporate taxation would be technically carried out in 3 steps. First step is all taxable profits and loss of each group of companies would be consolidated irrespective of the location of individual companies in the group. The second step is that the established tax base of a group of companies would be attributed to individual group companies using the distribution formula. And the third step, the tax base attributed to an individual group company would be taxed at the national tax rate of the country in which the company is located. The essential parts of this system are consolidation, reorganization, and distribution of this system. So common consolidated tax base. Consolidation is an essential element of the CCCTB introduced by the proposed EU directive, since the main tax obstacles facing society in the Union can only be addressed in this context. In addition, the loss incurred by the taxable person is automatically offset by the profit generated by other members of the group. Consolidation must include rules for distributing the results among the member states in which the members of the group own their business units. Eligibility for consolidation is determined in accordance with a two-part test based on control and ownership or profit rights. Rules on the reorganization of undertakings are also laid down to safeguard the rights of member states in the field of taxation. So the distribution formula for the consolidated tax base contains three equal weighted factors: work, assets, and sales. The labor factor is calculated on the basis of remuneration for work and number of employees. Each item represents half. The asset factor consists of all tangible fixed assets without intangible assets. Finally, sales must be taken into account in order to ensure the fair participation of the member states of destination. Now we have here the example. So we have here three examples. First example is that we are calculate the share through the distribution mechanism, where we take into account both sales revenues, fixed assets, and employment. In the second tip, we calculate shares through a distribution mechanism, where we take into account turnover and fixed assets without employment. And the third tip, we calculate the shares through a distribution mechanism where we take into account the elements of employment without sales and fixed assets. So this is the first example. And now we have analyzes this example. This analysis shows that the distribution of the tax base increases with those companies that have a higher percentage of sales and consequently a higher percentage of the value of fixed assets, while the share of the distribution of the tax base in those companies with a lower percentage of sale and the value of fixed assets consequently decreased. From this point of view, such a distribution formula would be fairly fair, since companies that achieve higher sales values would possibly also be heavier taxed through a higher tax base. Due to the rigid system of value of these items, there is a visible deviation in the case of companies that have low values of revenues from sales and fixed assets. This is shown by this example. So now we are approaching the end. What is the conclusion of this theme? So the introduction of the CCCTB would increase the transparency of taxation across individual EU member states, thereby helping to reduce tax uncertainty, as international companies could reasonably calculate in advance how much the actual tax burden will be at the level of the whole company. The CCCTB, with its current scope, would not offer a structural solution to some of the important challenges in taxing business of the digital economy. The CCCTB has a limited scope, and because the definition of a permanent establishment in the system CCCTB follows the one currently applied international. The profit allocation rules may not sufficiently capture the digital activities of a company. The rules of a taxable nexus for digital activities should be included also in the system. And the formula apportionment approach should be adapted in order to efficiently capturing these digital activities on this digital economy. So this is the end of my presentation at this conference. So here are my contact data. So if you have any questions, any possible thinking about digital economy and business taxation, do not hesitate to contact me. So that is the end of presentation. I would like to say thank you for the listening this presentation and see you soon.